Hey there everyone, it's Joe from Ainslie's Gold Silver Standard Insights, brought to you by goldsilverstandard.com and ainslieBullion.com.au. Today's topic is Fed interest rate hikes could finally be starting to slow down. Now that's posted on the Ainslie website. I'll put a link below for you to follow along. Of course, we have Chris Tipper here to break down the morning's news. And joining Chris today is regular contributor and Ainslie team member Branko Radunovic. So gentlemen, over to you.
Thanks, Joe. Well, the market surged into positive territory early this morning, our time, as Federal Reserve Chair Jerome Powell gave his acknowledgement that the start of the pivot has arrived by stating that the time for moderating interest rate increases may come as soon as December. The market seized on the expected step down from 0.75% to 0.5% and tended to overlook Powell's details that the rate peak is likely somewhat higher than the Fed's September forecast, and there's a long way to go to restore price stability. Today, Branko joins us to break down the market's reaction to Powell's speech and the implications of a sustained period of below-trend growth that gets us back to price stability. So welcome back, Branko.
Thanks for having me back on.
Okay, so it was a very interesting speech from Powell, and he did what he's done over the last few speeches, really, where he's been consistent in some regards. So he's consistently said, you know, we're going to stick with this, we're going to play it through. But then he's also introduced a little bit of mixed messaging in some ways, because now he's saying, but we might be starting to slow down from December. And surely he knows how the market's going to respond to that. So how did you sort of interpret what was said there and the messaging that Powell was giving?
Yeah, I find this a very interesting situation because, as we kind of know, I think he knew that his statements would cause the bullish market reaction that we did see. And that bullishness actually goes against what the Fed is ultimately trying to achieve. So on one hand, he's wanting to kind of calm the markets, raise rates, but then also he's really inspired some increased sentiment now with this announcement that he's going to cut, or not he's going to cut, he's could start to lower the increases as of December. And that'll be from 0.75%, which you've seen the past 2 months, to back to 0.5, and then who knows in the future where we'll be after that as well.
And it is a difficult job. Like you really wouldn't want to be the Fed chairman at any time, really, but particularly at the moment, because at some point, like it's not like he's cutting rates. Let's face it, like it's only talking about slowing, and it's still a very high rise to still do it at 0.5%. Yeah. But obviously, at some point, he has to come in and say we're going to slow down that rate of raising. But it did seem a little too optimistic, or a little bit too concerned, maybe, that we are heading into a sharp downturn. Now, the problem is going to be, of course, that people in the market are going to say, well, this will be caused by the Fed. So the Fed is ultimately responsible for creating the slowdown because that's what they were trying to achieve. So if they've been too aggressive and cause it too quickly, do you think maybe this is them backing off a little bit and saying, oh, well, don't blame us with the crash that's inevitable ahead? Is it something along those lines?
Yeah, I very much agree with that. I think they're trying to almost hedge that if everything ends up well, all fine and dandy, they're going to be, talking about what a great job they did. And then in the event they go overboard, it's going to be, we tried to slow it down, we tried to do the right thing, but the market didn't react. So I guess probably, I don't want to say taking a lack of accountability, but they're trying to, hedge both sides.
Play it both ways.
Yeah.
I have seen some sort of estimates that we're really heading to quite a sharp downturn in some of those forward-looking indicators. So what's your sort of prediction here? Do you think that we go 0.5% in the December rate rise, which seems fairly inevitable, and then we keep going at that rate, or is the pause after that? Where do you sort of see this playing out?
Yeah, I do agree. I think he's going to cut the rate to 0.5, and it also comes on the heels of, Eurozone inflation was announced yesterday, and that was lower than expected as well, from 10.6% last month to 10% this month. So the results from these rate rises are starting to show. So I think they will see that and then take the pedal off the gas. And, when you combine that with their kind of motto is, we're going to increase, but it's going to be over a longer period of time, I think we'll see that 0.5% for a considerable amount of months, 3, 4, 5 months before we see the next decrease, barring some inflation projections that come significantly under projected. I think we'll see that 0.5% increase continue for a few months.
So we could still have more, be expecting more rises ahead. And I think he did say that too, didn't he? That ultimately he expects the terminal rate or how high it actually gets to be higher than what they were predicting back in September. So he is effectively saying, just, this isn't the end, it's just a slowing. So I suppose that does align in that regard. But if we do see a sharp drop, it will be in economic activity and growth. It will be very interesting to see what actually happens out of that.
For sure.
The other angle I sort of wanted to explore a little bit, and I know you looked at that in today's news, was to do with the labour market, because this really, from my perspective, this is the part of the puzzle that's really confusing, because we've got a very strong labour market, and we've seen hints that may be starting to cool a little bit. But while that remains strong, you would think that that's going to continue to keep pressure on inflation. So what have you seen in regards to the labour market, and how do you think that impacts the bigger picture of what the Fed is doing?
Well, I think as we've discussed before, in the US, it's starting to weaken a little bit with a lot of these major tech companies like Meta laying off a lot of people. In Australia, it's actually a fair bit stronger at the moment. We were at a record low unemployment last reporting. But I do think that, this is kind of a weird situation we're in, where, he said in his speech that he wanted to kind of slow down wage growth, and kind of along with that comes kind of increasing unemployment. So, a strong labor market and a increasing, level of wage rises actually goes against what the Fed's trying to do. And I think that's a very difficult tightrope to walk, where, you obviously want to see the middle class prosper, but at the same time, you can't have their wages and, unemployment, their wages rise up too fast. So that's definitely, as he said in his speech, going to be a big hurdle for them to control that. But to some extent, I think that goes against probably the interests of a lot of people.
And I do still wonder how quickly the real pivot, as in pivot from slowing the rate of rising to actually pausing and potentially reducing rates, comes if we do start to see that unemployment rate take off. Because it's one thing to be focusing on inflation when everyone has a job, but when you see a lot of people without a job who are getting doubly hit because prices are going up and they don't have the income, surely that has to result in looser policy one way or another, whether it's the government working against the Fed too, because it might be more handouts in the form of unemployment benefits going out that are still fueling, putting money into the economy. Like something will need to break, surely.
Yeah, I think that's a great point. I also think that, a lot of these layoffs that we've seen the past couple of months aren't yet in unemployment data. So we could get into a situation where months down the line, unemployment starts to spike, and the damage of the previous rate rises have yet to come, coming to the data. So yeah, I think it's because it's a lagging indicator, it's going to be difficult for them to, it's probably going to be too late by the time they adjust if unemployment skyrockets.
Yeah, that all makes sense to me, and really just shows that it's a complicated situation. So we do need to sort of watch it month by month and speech by speech and data point by data point to try and figure out, because it's a slow rolling, slow moving situation. But certainly today, we're in that sort of risk on environment where it's all been interpreted quite positively. So if the market knows what it's doing, then it's a good sign. But notoriously, the market gets it right for a little bit and then rolls over again and starts to fear the opposite happening.
I mean, the strength of the market showed today. We can get into a bit of that now quickly. The Dow and S&P 500 just absolutely closed at highs. So much volume going through. It was a lot of bullish sentiment. I think I am a bit worried that in, like, let's say the 10% chance that the Fed decides to maintain rates, that could be quite significant.
So, as in another 0.75%.
Yeah, another 0.75% rise. That's going to be quite significant, because clearly this 0.5% has already been priced in, because you got this massive move. So I think more than likely we're going to see some negative activity on the actual day of the announcement, even if we end up staying the same.
Right. So and that kind of makes sense. So the risk bias would sort of be to the downside here, because the good news is being factored in as we speak.
Yep.
Okay. No, that all goes together quite nicely. So thank you for that, Branko. We'll keep watching. It's still a big data week. There's still data coming out for the rest of this week and really into the end of the year. But then it does sort of slow down a little bit over the sort of Christmas and holiday period where you don't get quite as much data coming out. But for the time being, at least, we'll keep watching closely to see what's driving what and where we end up next.
Absolutely.
All right, we'll talk to you next week.
Thanks. See ya.
See you, Branko.
Thank you, Branko, for joining us. And Chris, I'll see you on the next one. And for the audience, I want you to head over to the Discord channel. That's discord.gg/gold to continue the conversation. Chris and Branko will be there for the next 1 or 2 hours after the upload of this video. So head over there, ask your questions, get a response, and let us know your feedback. We really want to hear from you. I always want you to subscribe to the YouTube channel. That's youtube.com/Ainslie Bullion for the wide range of informational videos we put out 5 days a week, including specials and more. And while you're on the internet, head over to goldsilverstandard.com because that's bringing gold and silver into the digital world. As we say here at the end, balance your wealth in an unbalanced world. Take care, and we'll see you next time.